You want to know how the wealthy build empires? It starts with leverage. Leveraging $1 million asset for only a fraction of the cost. In this video, I'm going to explain it. If you don't understand what leverage means or how it works in real estate, I'm going to show you the numbers. I'm going to break it down because so many people don't understand this, and I think it's vitally important. I just saw something recently, and it continues to come up when wealthy people talk about real estate, and they talk about one of the most magic things about real estate is you're able to leverage. Now, simple analogy is you leverage the bank's money, you put down 5%, the bank puts in the other 95%, and you're able to buy that asset. Watch when I show you the numbers, how this throws totally out the window the argument that people might make that, oh yeah, even though your house doubles and triples over a few decades, it's only keeping up with inflation. So real estate isn't appreciating as much as you guys think because it's only keeping up with inflation. Well, once you use that leverage component, because most all of us buy real estate with leverage, there's I shouldn't say very few, there's probably 15 to 20% of homes sold get bought with cash. And this varies by market, and this varies by price point and demographic, but more than 80% of us buy homes with loans. We use the leverage to buy that asset. Let me just show you, because I think it's like anything else, a lot easier to understand when you see a visual of it. And I'm going to show you this visual, a $500,000 piece of real estate. You buy this $500,000 piece of real estate with 5% down, you've got $25,000 invested. If you wanted to buy $500,000 worth of Apple stock or literally any other investment in the world, 99.9% of the time for that $500,000 investment, you're going to have to use $500,000 from your bank account to invest in it. Real estate, different. You use $25,000. Now you control this $500,000 asset and you get the appreciation on the whole thing. It's all yours. The bank doesn't share in the appreciation. The bank doesn't share in any future profits. It's all yours. And so if you take that $25,000 invested and you look at a 4% appreciation rate, appreciation meaning you bought it for 500, in a year from now, it's worth 520,000. Why are we using 4%, Matt? Well, historical averages are about 4% appreciation. Some markets higher, some markets lower. California, as much as people want to knock this beautiful state because it's imperfect, and I'll be the first to admit as a California resident, some things I don't particularly like or agree with. One of those being state property taxes being 13.3%, but I digress. 4% appreciation, meaning you're going to buy it for 500. If it appreciates in an average year by 4%, that's a $20,000 increase in your investment on what it's worth, right? That's equity. Now, $20,000 in equity in 1 year versus the $25,000 you invested, that's an 80% return on investment. You're not comparing a 4% appreciation versus, hey, Matt, I got this crazy high yield savings account that's going to pay me 4.5%. Why would I buy a piece of real estate and have the risk and everything else associated with that when I can get 4.5% in this savings account? Well, you're not accounting for leverage. Leverage is the magic sauce. And the thing I forgot to mention about California as I stirred up some of the cons about California is that over the last 40 years, 5.9% appreciation is what we're looking at, right? And when I look at anybody's portfolio from California, me and my family's included, it is magical to look at what it's going to be worth in 5 years, 10 years, 20 years down the road, because it's going to appreciate year on year on year. Again, like Apple stock that doesn't go up in a straight line, it's going to get some pullback, then it's going to go up, then it's going to pull back, then it's going to go up. Over time, if you look at the graph starting at the left and going to the right, it's going to go up, undoubtedly, right? Apple stock's worth more than it was 5 years ago, worth more than it was 10 years ago, and you can say the same thing for 5 years from now and 10 years from now. Will there be a point where it goes up and then pulls back, up and pulls back? Yes. Real estate the same way. You might be in a market in 2025 where real estate has gone down 6% over the last 2 years. Austin, Texas comes to mind. Florida markets come to mind. They had a peak, some of them in 2022, and insurance costs and interest rates and inventory and all these other factors have caused it to pull back a little bit. But guess what happens if you look far enough to the right on this graph, 5 and 10 years in the future? Guess what's going to happen? It's going to go up in value. And the magic still lies in what I'm seeing right here, the leverage component of it. If you bought that $500,000 piece of real estate for $500,000 and you paid $500,000 cash, that might be a lot of risk for a 4% return. But again, we have to use math. If you're in at 5% or 10% or even 20%, you get to use that in your equation, because in this same example where you put a 10% down payment, now you've got $50,000 invested and it goes up by $20,000 in an average year, which, by the way, once it's worth $520, it goes up 4%. It's going to be a little bit more than $20,000, but it goes up $20,000 against your $50,000 initial investment. That's a 40% return. But no matter what way you slice it, these 20, 40, 80% returns are phenomenal. It's magic. And then you go buy a new primary residence and you rent your old one, and you've got somebody else paying the mortgage while this thing appreciates year after year after year. Hopefully this clarifies it for some people. There's truly magic in this leverage piece of real estate that doesn't exist in so many other investments. Should real estate be your only investment? No, I'm not saying that. Is real estate something that comes without any hassle or trouble or issues? No, I'm not saying that either. All I'm saying is look at the track record over 100+ years. And I heard some fun facts from a colleague this morning at a real estate meetup where they were talking about things going on in the 1800s with real estate, and Sacramento, California went from 1,000 residents to 10,000, and the gold rush and all that good stuff. Since homes were even existed, there's been a dynamic where they increase in value every year if you look at a big enough time horizon. I have to add that little caveat because you're going to look back at the last 100 years, you're going to tell me that there's 6 years where homes actually depreciated. Fair enough. But if you look at a 5-10 year time horizon, then left to right on a graph, they always appreciate in value. And you can say that, right? Give me any point in time where a piece of real estate is worth less 10 or 15 years later than when you bought it. It just won't exist, right? And the cooler part is when you see the $300,000 piece of real estate go to $600,000, that's 100% return, which is really nice. But if you consider you only put 10% down on that $300,000 piece of real estate, so you're only $30,000 in, and you saw $3,000 or $300,000 in appreciation, now you're talking about is that 1,000% return? Wow. What an investment, right? And leverage is the true magic. It's how people who have amassed great fortunes have used the bank's money, other people's money, to outsize their returns, to turn a 4% appreciating market into an 80% return, to turn maybe a 20% down payment on an investment property. It essentially just 4x's your return. That 4% might be 16%, and you might buy it in a market that's going up a little faster, so it's a 20% return. All of that while the investment property is fueling itself when it comes to monthly payments. And so you also take into account the debt pay down, where not only does it go up in value and you get to see the 4% appreciation, but we didn't even touch on the debt pay down. We also didn't touch on depreciation and tax benefits. I'll cover those in another video. But for now, I just wanted to pound into your head leverage, true magic in real estate. Hopefully you understand it better. Let me know if me and my team can help in any way. We're more than happy to. We're licensed in 48 states. And so we're happy to look at your scenario no matter where you're at. If you're in New York or Massachusetts, I'm going to refer you to a great broker I know. If you're in the other 48 states, go to greatmortgagebroker.com fill out the form. We'll help you out. Go there even if you're in one of those 2 states, because I'll take that and I'll refer you to the great folks I know in those 2 states. GreatMortgageBroker.com. We're more than happy to help. Thanks for watching. You're welcome.